Assalamu alaikum and welcome you all to the day 4 of Practice to Pass F4 English Law. So in the last 3 days we have been talking about different topics related to your paper, and we have been discussing different questions, and I've been taking questions from you guys as well. So today we're going to talk about some more issues, some more technical topics related to F4. So first we're going to cover the major technical knowledge area, and then we'll do some questions regarding that knowledge. I hope my voice is clear. If you have any difficulty hearing me, kindly just let us know. Okay, so let's just begin with the session. So today the topic that we will be starting off with is director, and well, we talked about loan capital and dividend law yesterday, and we just go through some questions related to this topic and start our next topic. So we have talked about loan capital, debenture trust deed, and rights of the debenture holder. Well, these are the differences between debenture holder and shareholder, where shareholder is the owner of the company, debenture holder is merely the creditor of the company. Shareholder can vote, debenture holder cannot vote. Shares cannot be issued at discount, while debenture may be issued at discount. So dividends are paid as form of return on shares, and interest is paid. And interest is paid whenever it is due, and dividends are just declared and paid later. And when you are going to redeem the share, there's certain restriction until and unless it is already redeemable. However, the loan is to be paid at the maturity date, and at liquidation, shareholders would come after, and the debenture holder would have the priority over the shareholder. So we talked about debenture holder yesterday, and let's have a look at the question. Which of the following statements in relation to company finance is correct? Shares can be issued at discount to nominal value. Debentures can be issued at discount to nominal value. Both shares and debentures can be issued at discount to nominal value. Well, the answer is B. Shares are not normally issued at discount to the share value, nominal value. There are certain exceptions, but normally shares cannot be issued at discounted value. Which of the following is not a type of share of a company? Ordinary, preference, special. Well, as you all know, special is the answer. And then we talked about charges as well, fixed charge, floating charge, and we talked about priorities as well. Well, in the context of company finance, which of the following statement is true? Fixed charge rank lower than floating charge of Indica. Fixed charge rank lower than preference shares of Indica. Fixed charges are security over a specific asset. Fixed charges are security over class of assets. Where fixed charges are ranked higher than floating and share preference share. So the answer is C. It's on a specific asset. So these are just knowledge-based questions. If you have the knowledge of the area, you would be definitely able to answer the questions properly. In the context of company finance, which of the following is usually repaid first on liquidation? Floating charge creditor, ordinary shares, fixed charge creditor, or preference share? Well, fixed charge creditors takes the specific asset, so on liquidation, floating charge holders are paid first. And these are the certain methods of capital reduction. We have talked about them as well yesterday. And dividend distribution. In relation to debenture issued as a series, which of the following describes the term pari passu? So all debentures rank equally. Older debenture rank above new debenture. Higher value debenture rank above lower. And the answer is A. equal. Which of the following statements regarding the difference between loan capital and share capital is correct? Unlike loan capital, share capital does not have to be repaid. Loan capital has voting rights. Well, it does not. Share capital offers the holder more security than the loan capital. Share capital is transferable, but loan capital is not. Could not be B or C, it's either A or D. Unlike loan capital, share capital does not have to be repaid and share capital is transferable, but loan capital is not. The share capital has to be repaid at liquidation only, and generally loan capitals are not transferable. So D could be the answer. How many days after creation must a charge be registered in order to be valid and enforceable? 21 days. You can find the theory in the slides and in the book that you're following. Which of the following events will cause a floating charge to crystallize? So crystallization is when a floating charge is converted into fixed charge. Well, resignation of the finance director, the chargee appointing a receiver, sale of the asset subject to the charge. Well, the asset is not subject to the charge, no particular asset. So whenever the chargee appoints a receiver, that is the instance when it crystallizes. So borrowing powers, regarding the borrowing powers, which one is correct? All companies registered under Companies Act 2006 have an implied power to borrow. The member of public companies registered under the Companies Act must authorize the company to borrow. The Companies Act 2006 sets a maximum limit on the amount each of the company may borrow. No. Well, shareholders specifies the amount that a company can borrow in the AOA, so member specifies it. It varies from company to company, and they give this authority to directors. So who borrows? The director borrows. Where is the authority given? In the AOA, in the Article of Association. By whom the authority is given? By shareholders, by member. The authority is given by the shareholders and members. So these are the certain questions regarding the area that we have covered already. So today we will be talking about officers of the company, and one of the most important officer in a company is director. Director, one of the most important officer in a company. So who is a director? Well, director is a person occupying the office and occupying the office and performing the duties of the director, occupying the office or the position and performing the duties, Anybody who is performing the duties of a director is deemed to consider the director. A person who is responsible for all the overall direction of the company's affairs. All company must have at least one director, and PLC need to have two directors. So the definition and the criteria is based on function. Whoever performs the day-to-day function is in a company, day-to-day function of management in a company is a director. It is based on function, not the title. Anybody performing day-to-day management functions is basically a director. And the minimum age that is required to become a director is 16. 16 is the minimum age that is required to become a director. So there are certain categories of director, certain types of director. Well, one of the director is DJO director. DJO director. DJO director is that director who is formally appointed by the company as a director to perform the duties of the director. Formally and legally, appointed or elected by the company to perform the duties. So is formally and explicitly and legally appointed by the company. Then we have a de facto director. You can see all these things over here on the slide as well. A person is expressly appointed by the company as a director is de jure director. With de facto, a person who is held out by a company to be a director and who performs the functions of a director, although they have not been validly appointed as such. So, de facto director, basically, he is not a de jure director, is not a de jure director. That means he is not formally appointed, not formally appointed, and they are called directors because they perform all the duties of a director, and they are director. They are basically pulled out by the company as director in spite of being not being officially appointed. So through holding out, the de jure is through express agency. This is the holding out factor, de facto director. Normally to fill up casual vacancies, they come up. Then we have shadow director. Shadow director. Shadow director again is a director who do not hold the office of director, who do not hold, the person who do not holds the office of director is not a de jure director, and but he performs all the actions and all the duties of the directors, and normally the other directors are accustomed to his orders. They follow the orders of this director, shadow director. Previously, shadow directors were not considered directors and there were not duties on them, but now they also have different, they also owe different fiduciary duties to the company. So a person whose instructions the other directors are accustomed to follow. The rule is to prevent a person from not taking part of appointment as a director, but using their position. So he's not a director, but he's using that position. De facto non-executive shadow directors still owe the duties. So remember, both of these are not the directors, shadow and de facto, but they still owe the duties. We're going to talk about duties of the director. So they owe the duty, they are accountable for, they are not directors, especially shadow directors, but they still owe the duties of the directors to the company. Then we have some other directors. One of the most important one is MD, Managing Director, is also known as CEO, Chief Executive Officer. So he is appointed to carry out day-to-day functions in a company, day-to-day duties, day-to-day operations of the company. So they are appointed to carry out day-to-day operations in a company. So CEO is the person basically who runs the company, and you must have studied that in corporate governance. Is the person who runs the company, makes the decisions, and carry out day-to-day operations of the company. He has a dual role. CEO is a member of the board as well, and he has to perform the executive duties as well, day-to-day, involved in the day-to-day running of the business. And he has all the apparent authority. We have studied authority in agency. So MD or CEO of a company has apparent authority. And through that apparent authority, As we all know that directors are agents of the company. So they can have the authority that agents have. So which authority the MD or CEO has? Well, apparent authority. Apparent authority of what? Apparent authority to enter company into the contract of commercial nature. Into the contracts of commercial nature. They can bind the company. And likewise, then we have executive directors. Executive directors are the one who are supposed to manage the day-to-day running of the business, day-to-day running of the business, of the operation, managing all the operation, performing day-to-day running of the business, and a crucial part of an organization. Then we have non-executive directors. Non-executive directors. Well, non-executive directors, what do they do? Well, they are appointed on, as you all know from corporate governance from a previous study, they are appointed on part-time basis. They are not permanent employee. They are not employee of an organization. And why are they appointed? Because they bring external expertise to the board. Because they bring external expertise to the board. And they are basically a part of the board, as they are part of certain committees on the board, as you must have studied in your corporate governance, and they have independent view, and basically they exert control and scrutinize the performance of executive directors as well. This is their one of the major roles. So you must have studied that in corporate governance. So these are some more directors: managing director, CEO, and executive directors, and non-executive directors, and who else? Who else? We have a chairman as well in a company. We have a chairman as well. Chairman is also a director, and the chairman, where CEO runs the company, chairman runs the board. Chairman is responsible for the effective running of the board. Chairman is going to decide that what is the what's the agenda of the board meeting is going to be, and who is going to sit in the meeting, who can talk in the meeting, how can they vote in a meeting, and all the basically he controls the board. He runs the board and makes some strategic decision. So we need his consent, and he's the ultimate authority of the board. And yes, when it comes to voting, he can vote as well. Can vote as well. The chairman important for the running of the board. Then we have alternate director. Well, if there is a director and he sees that it is impossible for him to attend a board meeting because of some professional matters to attend, he or she can send an alternate director at their place. This alternate director will attend the meeting. They can speak on their behalf as well. They can vote on their behalf as well if required. And they can be from the same company or different. They can be any person from same company or different company. So this is what an alternate director is. And it can be from the company or from outside. So these are certain types of director that you may find in a company. The junior director, shadow director, de facto director, they have all the duties: executive director, board of directors, elected representation of shareholders, acting collectively in the management of a company. Non-executive director, chief executive or MD, One of the directors of the company appointed to carry out overall day-to-day management function. The CEO MD has wider apparent authority. Well, he can alone bind the company into contracts of commercial nature. Let's have a look at some questions. Try and come up with the answers in your mind before I tell you the answer. That will be more helpful for you people. So, where a person is held out by a company as a director and performs the duties of a director without being validly appointed, what is that person deemed to be? A de facto director, a shadow director, or an executive director? Well, that's the definition of a de facto director, when a person is held out by a company as a director. To whom does a director owe their statutory duties to? Do they owe their duties to the shareholders of the company members, board of directors, or the company as a whole? Well, the answer is, well, they owe their duties to the company as a whole. So these are certain categories of the director. Okay. Then there are certain, as I told you, the minimum age to become a director is 16 years, and then there are certain rules regarding the appointment of the directors. The first directors are mentioned when the promoter goes to the registrar with the 5 documents, and one of the documents is a statement of company officers. First directors are selected at that point, but those first directors have to retire on the first AGM, because generally the directors are appointed by an ordinary resolution, at the AGM. We'll talk about meetings today or tomorrow in our discussion. Well, where special resolution, as I told you yesterday, is done by 75% voting, and ordinary resolution requires the majority, 51%. So in a meeting in the AGM, if 51% of the members agree, then a director is appointed. This is how a director is appointed. For a public limited company, the minimum requirement is to have 2 directors. However, for a private limited company, the requirement is to have 1 minimum director, and are normally appointed by ordinary resolution. So methods of appointment, appointed as part of its formation, the statement of proposed officer. When moving on, subsequent directors are appointed on ordinary resolution basis. Ordinary, with their ordinary resolution from the members. Excuse me. And the directors basically can be asked to vacate their office. So this is how they're appointed. Well, this is how they can be asked to vacate their office. There are certain issues regarding that. We'll discuss that in a while. Companies, publicity, company must give 14 days notice to the registrar. Whenever there is a director appointed, the notice should be given 14 days, within 14 days to the registrar, so that the register can be updated. Remuneration of the directors normally include fee and reasonable expenses, and usually they are reimbursed. And all these remunerations are mentioned in the report, publishing the annual report to members of quoted companies. So director remunerations are important part of that. So how does a director vacate an office? There are these situations when a director would vacate an office. He would resign. He can resign, not often to be re-elected, through death, dissolution of the company, disqualification, and removal. So, director will be asked to vacate the office. Of course, automatically happens by the death of the director. It automatically happens by the dissolution of the company. When the company is dissolved, the director would have first to vacate the office, and this can be done through resignation as well. So the three technical areas are re-election and disqualification and removal. So these are the three technical areas, these are the three obvious areas through which a director will be asked to vacate the office. So let's talk about these three areas one by one. So retirement and re-elections of the directors, retirement and re-election of the directors. So the directors of a company, so at the first AGM, at the first annual general meeting, all the directors, all the directors should retire. They are going to retire and they are going to propose themselves again for re-election, for re-election, and again there is going to be voting, and again you need an ordinary resolution for them to come back to their office. And remember, this happens during the time that is specified in their contract. They come for 3 years. Well, during that time, well, they'll have to retire and they'll have to offer themselves again for re-election. There's going to be voting again and again. If 51% says they agree to bring him back as a director, only then he can come and take up the office. And at the first AGM, the rule is that all the directors should retire. Then at subsequent each AGM, maximum there should be a weighted average number of a director that should retire, and normally it is 1/3. 1/3 are asked to retire and get re-elected. Retire, and there could be the one older, the one who have not faced retirement before, so it could be those one. And so whenever the director is appointed and retired and elected again, the company must notify the company's house within 14 days. Within 14 days, you need to send the notice to the company's house or to the registrar, company's house or to the registrar within 14 days, and you need to tell them of the appointment of the new director. Need to notify them of the appointment of the new director, and they automatically get the implied authority and they become the director, and they automatically through implication become the implied agent of the company as well. So these are the rules regarding retirement and re-election. Rotation. At the first AGM, all the directors shall retire, and any directors appointed by the other directors since the last AGM, whenever there is a casual vacancy, they should also retire and propose themselves for re-election, and directors who were not appointed or re-elected at one of the two preceding AGMs. So if you have not been going through this whole cycle from last two AGMs, past 2 years, you should retire this year. So these are the rules regarding rotation. You need to know all these technical aspects of this area. It's really important. So if you have any questions, you can put that in the question box. So a director can be asked to vacate the office through death, through dissolution of the company, through resignation, and when they offer themselves for re-election and they do not get re-elected, If they do not get re-elected, if 51% says no, 51% says no, we do not want the director to come back, then we'll have to definitely vacate the office. So next up is disqualification and removal. Let's have a little discussion about disqualification of the directors. So director will be disqualified under Companies Director Disqualification Act, and that director cannot take up the position of director in this company or any other company for the disqualification period, and they'll have to vacate the office if they become bankrupt. And what does the Company Director Disqualification Act says about the disqualification? When does a director becomes disqualified? There are certain situations, you must have studied that before as well. So these are certain situations according to the certain grounds in the article. When does a director get disqualified? Well, one of the situations is whenever a director is involved in some sort of indictable offense within UK, within the country or outside the country, regarding company's management or running of the company, and then whenever is involved, not in a minor, some of them in a major indictable offense, so regarding the management of the company, so he is entitled to disqualification. Basically, he would be disqualified uh, for certain period, and he cannot act as a director during that period. Whenever the director is in persistent default in relation to provision of company's document to the company's house, company's document specifications to the company's house or the registrar, and when he's persistent in that, and persistent is when in a period of 5 years you have done that 3 times, that is enough. 5 years, if you have done that in three instances, that is more than enough to be called as persistent default. If he is involved in this sort of persistent default, again he would be disqualified. Whenever is involved in certain fraudulent behavior, we will talk about fraudulent behavior in the coming chapters tomorrow, inshallah. Whenever that which is a big wrongful offense which a company cannot do, the director cannot commit. Whenever the director is involved in competition violation, certain rules regarding competition is violated those rules, or the director is involved in wrongful trading again is disqualified, or when a director is termed unfit, whenever the director is found unfit by the Secretary of State to perform the function of the management of the company, and he must have been notified by the auditors or by some higher management authority in a company. When the auditors, inspector, higher management authority in a company notify the Secretary of State and they actually find the director unfit for the purpose to perform the management of the company, the director is disqualified. There are certain brackets to that. Well, with indictable offense are disqualified maximum for 15 years. For persistent default, you're disqualified for 5 years maximum, 2 to 5 years, 2 to 15 years. For fraudulent behavior, again 15 years. For competition violence, again 15 years. That is the maximum, that is the cap. For wrongful behavior, again 15 years. And for considered being deemed to be unfit by Secretary of State, again 15 years. So it is lesser for the persistent default, because default could be because of the error as well. It is not necessary that it is due to the fraud. It could be because of the error as well. For rest of it, it is 2 to 15 years. So these are the brackets for disqualification. So a director can be asked to vacate the office through disqualification as well if it becomes disqualified. And removal. The next topic is removal. Removal is, well, can the director be removed? Yes, if a director can be selected by an ordinary resolution, director can be removed as well by an ordinary resolution. A meeting is called now and an ordinary resolution is passed. 51% of the shareholders says that yes, this director should be removed. Well, the director is removed and he will have to eventually vacate the office. So you should know all these 6 areas to which a director is disqualified. Which of the following are not ground for disqualification under the Act? Persistent breaches of the Companies Act, unfitness to manage a company, unfitness to manage a company, committing a criminal offense. Well, that's a wrong question. I think one of the options is missing from here because these are the grounds for disqualification. Let's just skip this question. Sorry for that. In a company law, which of the following is not a statutory duty of the director? Where we will be talking about duties of the director in a while, and then we will be able to do this question. So disqualification grounds, as I told you, indictable offense, persistent default, guilty of fraudulent trading, by investigation Secretary of State, unfair, and directors involved in competition violations and wrongful of everything is mentioned over here. So it can be mitigated by these factors if there is lack of dishonesty from the director side. So director's powers are deemed to be defined by the article. So we will be talking about the duties of directors in a while. Let's a break. So we continue with that. Welcome back. So let's just start from where we left. Okay, so next up is an important area regarding directors' duties, and so there are certain duties which the director owe to the company. The topic of duties of directors, and these are 7 main duties that you should know about. 7 main duties that you should know about, and those are mentioned. So starting from fiduciary duty, a duty imposed upon certain persons because of the position of trust and confidence in which they stand in relation to each other. So the most important position of trust and confidence in a company is the director's office. If you're sitting as a director in a company, so there is certain fiduciary duty of to act in a good way, in a way that is beneficial for the company. However, we have certain statutory duties as well, as I just mentioned. So we'll be talking about these duties. Um, the very first duty is duty to act within power. So directors have all the power to run the company. Directors are the one who borrows for a company and create debentures. Directors are the one who issue shares. Directors are the one who calls the meeting. Directors are the one who declare interest or dividend. So directors have all the duties and these all the power, and these powers are given to the directors in the company's AOA, Article of Association. And directors should make it a point that they should always and always act within power. If they're going to act outside the power, their act can be ratified by the company. If the company wants to do that by the shareholders in an ordinary meeting, they can ratify their act if they find any lack of dishonesty. Otherwise, you'll have to suffer the penalties for breaking the duties of the director, not fulfilling the duties of the director. The director has to act within power all the way, and directors should always and always work for the success of the company, promote the success of the company. And when we say success of the company, we are talking about long term, and the long termism factor comes up in here. We're talking about long term. Decision should be taken with the viewpoint of long term success of the company. Sustainability should be assured, should not be on short term gain or short term profit basis. Directors should always and always exercise independent judgment whenever they are required to give judgment, their point of view. They should show independence. There should be no biasness. There should be no prejudice, and they should be independent in their judgment. And directors should exercise or show reasonable care, skill, skill, and due diligence. Due diligence, which is expected out of a person holding that. So there are two levels: expecting out of a person holding the seat, and with the level of qualification, and most importantly experience that they brought to the seat that they bring to the seat. So they're required to show the reasonable level of care according to them. And whenever it is possible, in fact, they have to do that always and always avoid conflict of interest. They should not seek their personal interest, however, they should be uh, following and they should be working for the interest of the company. And they are not required, they cannot accept benefits from the third parties. From the third parties. Not required to accept benefits from the third parties, and they should always act independent. Benefit bribes should not be taken from the third parties at all at any level, and they are required to declare interest in proposed transaction. Proposed transaction. So, for example, if a company is thinking to acquire another company, and if a director has shares in that company, director is required to declare before the decision is made. The director is required to declare that he has an interest in the proposed transaction. How can he do that? Well, he can do that by sending notices, written notices to the concerned parties or members of the company. He can do that by writing a general notice, say for example at the notice board at the company, or he can simply stand up and speak at the general meeting and say that I have an interest in the proposed transaction. They are required to do that. They are required to do that. So these are the 7 duties that the directors are supposed to show, directors are supposed to follow. They owe these duties to the company, not to the shareholders. Act within power, section 171. You're not required to remember these sections or date in these in all of this paper. The examiner will not be asking about the date. Promote the success of the company in long term, of course. Exercise independent judgment, reasonable skill, care, and diligence. Avoid conflict of interest. Not to accept benefits and declare interest in proposed transaction. So these are the duties for the directors. So if you're going to breach the duty, director may have to account to company for personal gain. Whenever there's a personal gain, director has gain, and as a result, as a consequence of breaching the duty, director has to account for and indemnify the company. He has to bring back that profit into the company's account, and company can resign the contract or can even declare it ultra wires and unlawful. So where directors have breached a duty, company may authorize to ratify the act. This can only be done by provision in the articles of passing the duty. If your AOA says only then you can ratify the act, or if AOA does not allow that, you need to pass a resolution. And the right is restricted if the directors who are also members defraud the company and then ratify their acts in general meeting. It may also be restricted if the directors' acts alter the share balance to allow subsequent ratification. So an act of a director can be ratified if it is mentioned in the AOA or if a general resolution is passed. And the director should not be voting for that. So let's have a look at the question. A director is in breach of statutory duties. Which of the following statement is not true? Director owe their duties to the company as a whole, not to the individual members. The director may be required to make good any loss suffered by the company. Any property taken by the director from the company can be recovered from them if it is still in their possession, and breach of statutory duties is grounds for disqualification under the Company Director Disqualification Act. So breach of statutory duty is not a ground for disqualification. We have not studied that in disqualification. The duty of care should also be shown. We have talked about duty of care and tort in the tort area, chapter of tort. And directors are not liable for a company's death. Members are. Well, director can become liable if the veil has lifted and they're found guilty, if the provision is in the constitution, if through a special resolution we have announced that director should be liable for the company death or under some insolvency situations. We'll be talking about insolvency in tomorrow's session, inshallah. So let's have a look at some more questions. Which of the following describe the actual authority of a CEO? The authority that the board expressly gives it to them, the authority that is usual for a chief executive officer, the authority that the chief executive officer says to others that they have. Well, let's see. Talking about authority of a director, a director can have three sorts of authorities: express authority, implied authority, and ostensible or apparent authority. Ostensible, as we have studied in the chapter of agency, director is an agent of the company, so he can have ostensible authority, apparent authority as well. Expressly, what is given to him implied through his position, fiduciary duty, and ostensible is apparent authority. The MD has ostensible authority. So if we talk about actual authority, so actual is board has expressly given to the CEO. What is the minimum age that a director can be? 60. 16 is the minimum age. Which of the following types of directors is expressly appointed as such? A de jure. De jure comes director is expressly appointed, express agency is developed. To which of the following does a director owe their statutory duties to? To the members personally, to the company as a whole, or to the board of directors? Director owe their duties to the company as a whole, to not members personally. Which of the following types of director is not validly appointed but is held out by the company to become a director? So holding out, de facto. Held out is de facto, B. In which of the following circumstances will a director be personally liable for the debts of the company? Where the company AOA state that they are liable, where a creditor has told them that they are liable, where they have breached their fiduciary duties. Well, directors are not liable, but they can become liable if the company's AOA says that. A. Which two of the following describes the level of knowledge, skill, and experience required by a director in order to meet their statutory duty to exercise reasonable skill, care, and diligence? The knowledge, skill, and experience that director actually has, the knowledge, skill, and experience expected of the director to by the board of the director, the knowledge, skill, and experience that is reasonably expected of a person carrying out the functions of the director, the knowledge, skill, and experience that the members of the company believe the directors to actually have. So, which two of the following describes the level of knowledge, skill, and experience? Well, as I told you, it has to be two levels, and number one is the knowledge, skill, and experience that they have, and number two is that coming out of a person with such qualification and such experience, what do the other directors expect out of them? The answer is A and B. What is expected from a person with such qualification and experience, and what they actually experience that they have, actual qualification that they have. So the answer is A and B. Whenever the examiner would require you to mark two options, he would definitely be highlighting the two. Keep that in mind. When he asks you to choose two, you'll have to choose two. Which of the following describe the correct way that directors should use their powers? For any reason necessary to maximize the profit, to achieve the goals of the business, for a proper purpose that is honestly believed to be in the best interest of the company, or for any legal purpose? Well, the answer is C, proper purpose. Proper purpose that is in the best interest of the company. They have to be for a proper purpose. They have to act within power. So these are certain issues regarding the company's officer, one of the major company officer, and that was the director of the company. So another officer that a company has is a company secretary. That is another officer. Let's talk about company secretary a bit. Company secretary. Um, A public limited company must have a company secretary. It is a compulsion for them. However, a private limited company, it is not compulsory. It is not a must, but they can appoint the um, company secretary. It's not compulsory. So for a public limited company, if it is compulsory, it is the secretary is also a director as well. So we have a requirement of 2 directors minimum and 1 secretary, and secretary could not be the person from them. So he has to be a different person. And the company secretary is basically appointed by the directors, appointed by the directors. Directors appoints the company secretary. Every public company must have a company secretary with requisite knowledge and skill. Private companies are not required. Responsibility, statutory, we'll be talking about responsibility in a while. So they're appointed by the other directors. So who can become a company secretary? What is the level of qualification that is needed to become a company secretary? And it is appointed by the directors, and the qualification, the secretary should be a qualified person. He should have any degree regarding, he could be a solicitor, he could be a barrister, he could be a member of authorities like ACCA, ICAEW, SEMA. So he could be the member of any authority, or he could have any qualification regarding register and any qualification related to law. So moving on, what are the certain duties of the secretary? What does the secretary is required to perform? Secretary would basically check that all the documentation they are in order. Secretary would check that, and he would be submitting all the returns to the registrar. Remember when we say give a notice to registrar within 14 days, who gives the notice? Well, he is responsible, secretary is responsible, he or she is responsible for that, and the secretary would keep registers for the company as well, and secretary is required to give notice of the meetings. We'll talk about meeting in a while, of meetings, and they can keep minutes of the meeting as well. They're required to keep minutes of the meeting as well, and they are basically even required to countersign the documents, basically with the company, where a company seal is affixed. So all the documents With the company stamp is written, company seal is affixed, they are required to countersign the document, how to check the documents. So these are issues regarding the secretary and what is the power that a secretary has. Well, secretary is a director, and so director is an agent. So they have authorities. Secretary have express authority to perform all these duties, and they can even delegate the duties as well with a control, specified control. And they have all these secretary in a company would have employed authority, implied authority to make or regarding contracts of administrative nature, administrative nature, not the main contract, but relating, for example, issues relating to supplier, not buying from the supplier, but issues relating to the supplier, issues relating to the staff. So they have this authority of entering the companies into contracts of administrative nature. Previously, they had no such authority. They were just simply, previously, they were just simply doing bookkeeping, like a clerk, maybe bookkeeping, but that is not the situation any longer. Now they can make contracts with the employee, customer. Now they can enter the company into the contract. Now they have this authority, and all the secretaries in a company in English legal system have employed authority to do that. They do not need this authority from the company. They have this authority through implication. They have this authority through fiduciary duty of them being in a position of company secretary. These are certain powers that are given to the secretary. You should know all this stuff for company secretary. Who appoints them, what the qualification should be, what are the certain duties, and how much they can power that they can exert over the company. And they have ostensible authority to enter any implied and ostensible authority to enter any contract in the company. So qualification, a sole director of a private company cannot become the secretary. If the directors have two, if the company has two directors, in a PLC, it could be the condition that out of the two directors, one of them could be the secretary. But if you have one director, that only one director cannot be the secretary as well. So which of the following sets the specific duties expected of a company secretary? Who tells the company secretary that what the duties are? AOA, Companies Act, MOA, or the board of directors? Well, all the duties are mentioned in AOA, rules and regulations. Which of the following parties associated with the company may not act as its company secretary? A company sole director, company accountant, company solicitor. Accountant solicitor can become the secretary. However, a sole director cannot be the secretary. So you can put your questions in the question bar if you have any questions. So you must have a detailed, thorough knowledge of the topic, and then you should attempt the question. If you attend the question afterwards, after having the knowledge, that would be really beneficial for people. So another officer, one of the main officer was director, then we have secretary. Well, then another officer is auditor, and here we are talking about external auditor. We're not talking about internal auditor. We are talking about external auditor. So he should be a qualified person. He must be a member of any recognized supervisory body Anybody will need to have membership of any recognized supervisory body. Well, the auditor must not be must not be an officer of the company, an employee of the company, and they automatically are ineligible of becoming the auditor. A partner of such a person, director cannot become the auditor, a supervisor cannot become the auditor, a shareholder, of course, because independent is at stake. If you see that an external auditor should be an independent person. External director should be an independent person. So who appoints the director? Who appoints the external auditor? Sorry. Who appoints the auditor and when are they appointed? Well, they're appointed at AGM, annual general meeting, AGM. Generally, the auditors are appointed by the members at every AGM. For a private limited company, the last year auditor automatically becomes the auditor of this year as well. For the PLC, you have to select at the AGM. Members vote and select the auditor. I'm continuously saying director. So members selects the auditor at the AGM by ordinary resolution. At times, directors can select the auditor as well, but this is not usual. It is just at times, for example, just to fill up a casual vacancy whenever an auditor has resigned or died and vacated the office, or they need to fill up a casual vacancy. They are selected by the directors. Otherwise, directors are not allowed to appoint auditor. And if the member and directors have not appointed the auditor, the Secretary of State has the authority to appoint the auditor if after 28 days of circulating the accounts, the directors or the members have not yet appointed the auditor, when the Secretary of State then appoints the auditor for this particular company, external auditor. A person independent of the company, they are not permitted to be company officer by law and by the rules of the recognized supervisory body. Their appointment normally by shareholder but directed and at times Secretary of State as well. Which of the following is eligible to act as a company auditor? Employee of the company, partner of an employee of a company, accountancy firm responsible for producing the company's accounts. Well, C is the answer. Employee and partner cannot be the auditor. Which of the following parties appoints the company's first ever auditors? Members, registrar of the companies, or directors? Well, members. Members have the authority to appoint the auditor. So audit exemption. Some of the companies have exemption from the audit. However, they are not PLCs. Public limited companies cannot get the exemption from the audit. A PLC can have the exemption, and it is only, sorry, private limited companies can have the exemption only and only for private limited companies, and those private limited companies which comes under the small companies regime, which are considered small company. So they are considered small companies if they have turnover not more than 10.2 million, and if they have gross assets not more than 5.1 million. This is the condition. Turnover not more than 10.2 million and gross assets not more than 5.1 million. Net assets not more than 5.1 million. Then they are small companies and they have exemption from the audit. But this is not for public limited companies or banks or insurance. This is not true for such companies. So, auditors' statutory duties. What are the auditor's statutory duties? What are the external auditor's statutory duties? Well, an external auditor of a private limited company is automatically re-elected for the next year. That will be the situation for PLC. You have to do the re-election. So what is the statutory duties? You have to appoint that basically. So what is the auditor's statutory duties? So auditor's statutory duty is to give true and fair view of financial statements, and they have to show that, and they have to basically give their opinion that the financial statements, the accounts have been prepared according to the standards, prepared according to the international standards, as far as that is. So this is the one statutory duty. That is the duty of an auditor which is supposed to do. So for those duties, to carry out these duties, there are certain implications which you should do to carry out the duty. For example, you should see that the company is having proper books or record keeping, because only then you can assure that accounts are full fair and and then finally you have to say that the accounts are in agreement with those records, in agreement with the books. So to fulfill this one statutory duty, you can even have investigations from the other members and all that. So these are the basically statutory external auditors statutory duties. What is the power that is given to the auditor, or the rights that the external auditor has? Well, they have a right to receive a notice of all the general meetings, plus to attend and speak. It is not only that they would be just getting the notice. One right is of getting the notice, and then this right you can attend the meeting and you can even speak at the meeting. What else you can have? You can access the books all the time, the records all the time, and even, as I told you, you can have the discussions with the management. You can give quiet explanation from directors, from management all the time, and you can even convene a meeting. You have a right to call a meeting. A resigning auditor has a right to call a meeting to discuss the statement of circumstances. We'll talk about it in a while. That what statement of circumstances is. So the Director can resign from the office. Director can give the resignation, but he has the authority. He can resign at any time. But the company is required to perform the company's house to inform the company's house of the registrar, and they can draft the statement, a statement where they can write the circumstances, that why are they resigning, statement of circumstances, and they can even call a meeting. As I told you, they have this right. They can call a meeting and they can say that the meeting should come. We have to discuss our statement of circumstances, that what are the circumstances under which we are resigning. This is the situation when a director resigns. Well, auditor resigns. Well, an auditor can be removed as well. Removed by whom? By the shareholder. So can the shareholder remove a director? Yes, the shareholders can remove a director. Do you need a special resolution? No. We need an ordinary resolution, just 51% voting. But it should be at a general meeting. But the meeting should be with a special notice. Special notice of 28 days. So you need to give 28 days notice before the meeting, and then you can call the meeting and you can pass the ordinary resolution. 51% of the members say that remove the auditor, then you could remove the auditor. But auditors have a right to speak at the general meeting as well. They have to write and they have right to declare the statement of circumstances. Statement of circumstances whenever they are removed from the office. So termination of the office. Removal by ordinary resolution with special notice. Notice of 28 days. Auditor writes, submit a statement of circumstances. Written statement could be given and speak at the general meeting. Resignation in writing to registered office. Circulate a written statement of the members to the member. Request a general meeting. Speak at general meeting. Not seeking a re-election. Well, a written statement of circumstances is always required whenever it is leave. So whenever the auditors are appointed, automatically they say that they can say that they are not seeking any re-election, and for that sake also statement of circumstances should be given. Which of the following parties associated with the company may not act as its company secretary? Well, we talked about it, a sole director. Which of the following company must have a company secretary? Private limited company, unlimited liability company, or a public limited company? The answer is public limited company. Which of the following parties appoints the company's first ever auditors? Members, registrar of company, director? The answer is member. That's a repetition question. Which of the following sets the specific duties expected of company secretary? Well, article of association. Which of the following is a statutory right of a company auditor? To attend the board meetings, to vote in the company's general meeting, to access at all times the books, accounts, and vouchers of the company, to appoint non-executive directors. The statutory rights could be to access at all times the books, accounts, and vouchers of the company. Which two of the following are criteria that a private company must meet to be exempt from an audit? Turnover not less than 10.2 million, balance sheet total not balance sheet total less than 5.1 million. Sorry, turnover less than 10.2 million and balance sheet total less than 5.1 million. We have talked about this. Average number of employees 30, long-term debt less than 4.5 million. The criteria is A and B. We have just talked about it. Unless a shorter period is agreed by the member, how many days notice must be given in respect of annual general meeting? 21 days notice. We'll talk about meeting in a while. 21 days notice. So in meetings, we'll talk about meetings and then we'll talk about all these areas in meeting. So let's have a short break. (11:35). So welcome back to the session. We were talking about different officers of a company, and one of the most important officer is the company director, and who has the fiduciary duty of trust in a company, and the company are managed by the directors. Companies are run by the directors. However, important whenever you need to take some important decision regarding existence of the company, important decision regarding structure of the company or scope of the company, any important decision, these decisions are taken by the members. Directors have no authorities to take these decisions. These decisions are until and unless delegated by members. These are taken by the members. And where are these decisions taken up by the members? Well, at the meetings. Members are required to come up at the meeting, and at the meetings, these decisions take place. So, through these meetings, what is basically implied that members can exert control over the directors. Members have given directors all the power, but through this meeting, they can exert control over these directors. Members tell them that they can remove the director as well. All you need is an ordinary resolution for that. And members basically approve their behavior. For example, they give them power to borrow, but they can change that. They can change that by altering the AOA at a meeting by special resolution, and by 75% voting, they can alter the AOA. So through meetings, the members basically do the decision making and exert control over the directors. So talking about meeting, there's one meeting is AGM, annual general meeting. Okay, so there's a question by Sheikh Hussain and it has been answered. The handouts are available at the handout section and recordings are available as well. You can follow any book you have, you can follow that book. Okay. So talking about AGM. So AGM is a meeting, annual general meeting. This is the meeting which is supposed to be called once in a year, and this is a statutory must for PLC. For PLC, it is a statutory requirement. So it is a statutory compulsory requirement for a public limited company to hold an AGM. Well, a private limited can do that as well, but that is not a requirement for private limited companies. Not required by law. Well, general meetings are the meetings which you can call anytime for any decision that you need. Well, it could be in response to need arising by either a member requisition or by the directors. Whenever a member is required you to call a meeting, you can call a meeting whenever a director has required. So in response to that, response to the request from the members or the directors, you can require these, you can call these meetings. So let's see what are the credentials for AGM. When we talk about AGM, timing of the AGM is once a year, held each year, and within 6 months of year end. Well, the first AGM is carried out within 6 months of the year end. That is the timing regarding the AGM. Well, notice, you need to send a notice period, and it should be written or specified by the AOA as well, and you need to give at least a 21 days notice. That is the minimum requirement for AGM, and in the notice it needs to specify that it is for the AGM. This is the requirement for the notice. So what is the basic agenda that is being discussed in this sort of meetings? Well, normally you declare dividends are declared, and directors are elected. Another important thing would be election of directors and appointment of auditors and discussion of the financial statements. Appointment of auditors, and the accounts are discussed as well. So these are the issues regarding annual general meeting. Well, for a general meeting, the directors may call a general meeting whenever they see fit and whenever they want to call the meeting. So if we talk about timing of the general meeting, whenever director or members want to call it, they can call the meeting. So if a member is requesting a meeting, the members should basically have 5% of paid up share capital or voting rights. So if a member is calling a meeting, the member should have 5% of paid up capital or voting rights. And the notice period that is required for a general meeting is a 14 days notice. Required to give a 14 days notice for a general meeting. And business, what is discussed in these meetings? Well, for whatever purpose, the meeting is requested, for whatever purpose the meeting is requested, that would be the business of the meeting. And why have we called up the meeting? For whatever purpose we have requested. So class rights meeting can also be class meetings can also be called, for example, a meeting of preference shareholder, but one third of the capital, paid up capital, is needed to basically see the meeting is going on. So this is what an AGM and general meeting is all about. And Whenever the meeting is called, so you need to see the decision making. So basically, let's see who can call a meeting. Well, normally the authority is given to the directors, like all other authority. Directors basically call a meeting. Resigning auditor, as we just studied, resigning auditors can call a meeting. Court or state, secretary of state can call the meeting, and members can call the meeting as well. Members can call the meeting as well. So when the members are calling a meeting, what are the rules? So members request the directors to call the meeting. Directors are required to send the notice within 21 days. Within 21 days of what? 21 days of the request. And the meeting should take place within 28 days notice. 28 days of the notice. It is if the directors do not call the meeting after 21 days of the request, member can call the meeting themselves, but they have to suffer the expenses for themselves. So when the meeting is there, the quorum is present. So basically, what kind of decision making? For the decisions, you need resolutions. So there are two kinds of resolutions basically: ordinary resolution and special resolution. For ordinary resolution, 51%, more than 50% vote is required for ordinary resolution, and if it is passed, the notice is sent in 14 days. 14 days, the notice is sent to the registrar, and the registrar is informed if the notice is a requirement. For special resolution, so these are the resolutions, the decisions that have been done at the meeting, which forms the constitution of the company as well. Well, you need 75% vote, 75% voting, and again the notice, 14 days notice is required. It is not a must for ordinary, but for special it should be given. And there is other category, and that is written resolution, when the members send their decision through writing. What they've written, they send their decision. But remember that this is only and only allowed to private limited companies only. It can be used for any sort of resolution, ordinary resolution or special resolution. Any sort of resolution. So if you are a member and you're holding 5% of the voting right, or at least 100 members with 100 paid up capital each, you may request a resolution already at the AGM. If you're sitting at an AGM and you're from the members side, and AGM is doing its normal business, which is this, but you want to add another resolution, well, you need to have 5% of voting right, or 100 members each with £100 share capital each on average. So if this condition is satisfied, then yes, you can pass a resolution, ask for a resolution to be passed at the general meeting. So this is what the meetings are. Some general little other things about the meeting, where the notice should be given to everybody. It should be sent. The notice should be sent to all the members and officers of the company. They're all entitled to receive it. It should have certain facts. What should be the date of the meeting? What is going to be the time of the meeting? What is going to be the agent of the meeting, and all that. And if a member cannot attend a meeting, they can send proxies. Any member, because member have to vote. So any member can appoint a proxy. They can send somebody else on their behalf to vote, and it's not a compulsion that proxy does not have to be a member himself or herself, and proxy has all the rights which a normal member have to speak at the meeting and to vote at the meeting, to demand a vote at the meeting. But quorum should be present. Quorum should be present. So it's not that one person cannot call a meeting until and unless it is a single member private company. So they should, the companies should basically, the AOA should fix a quorum. Quorum is minimum. What is quorum? Quorum is minimum number of people present to conduct a meeting, to start a meeting. So what's the basically procedures that are being followed at the meeting? Of course, all the meetings, basically the chairman presides all the meeting. You have two options. You can either go for show of hands while they voting, or you can go for a poll. And all the minutes of the meetings should be kept properly. And at times we say that there are these sort of resolutions, but at times there is a principle, and that principle is assent principle. Assent. Assent principle says that 100% voting is required. 100% votes are required to pass it. So the company's AOA can pass assent principle for certain decisions, and where they can say that 100% of voting or a unanimous decision should be there to make up a decision. So minutes should be kept, and a single member company, for a single member company, yes, you can say that the single member company, the quorum could be of one person, but normally the quorum is decided by AOA. So two ways to vote by show of hands or by polling system, voting for a poll. Well, if you're going to vote through show of hands, it would bring it is a quick method. It is a quick method, and this one's a little slow method. This is more transparent method, and this is not that transparent. You can follow either of the method you want. However, this is a little less fair, and this is a fair method because one share gets one vote, but if you have 10 shares, you can just vote once in the show of hands. So this is a little fairer method, and so these are the certain criteria for voting in a meeting of the stuff. So regarding meetings, unless a shorter period is agreed, how many days notice must be given in respect of AGM? For AGM, notice period is 21 days. For general meeting, notice period is 14 days. For a special meeting, notice period is 28 days. We just studied to remove an auditor. We need a general meeting with a special notice, and that is of 28 days. So which of the following is included in ordinary business of an AGM? Changing the company's name, reducing the company's share capital, approving the payment of dividend, appointing an administrator. Well, C, as you all can see, C is the answer. Which two of the following are rights of a proxy at general meeting? To vote on a show of hands but not a poll, to speak at the meeting, to requisition a resolution at the meeting, to demand a poll. Well, you can speak at the meeting and you can demand a poll. B and D. B and D are the answer. You can even demand a poll. So let's have a little discussion about the paper format since we are almost done with the syllabus. We're left with two technical areas that we'll be discussing tomorrow, inshallah. So, as I told you about the paper pattern, I told you that it is going to be a division of 70% and 30%. 70% you'll be getting MCQs, normally 25 MCQs of 2 mark and 20 MCQs of 1 mark, and 30% will be getting MTQs, multiple task questions. There would be a scenario and you would be required to answer questions worth 6 marks each. So there will be 5 MTQs worth 6 marks each, and that would be a total of 30. So let's have a look at an MTQ today. That how would an MTQ look like? Let's talk about one or two MTQs regarding the examples approach. Let's just wait for it to open. So you will not have to type anything in the exam. You'll be given, even for MTQs, you'll be given options. All you have to do is to choose. All you have to do is to choose. From the MTQ. So let's see. This is an NTQ, and regarding that NTQ, we have 2 marks here, 2 here and 2 here. So let's see, what does the NTQ say? If you have any questions, you can write them down in the question area. Okay. Let's see. On Friday, 10 December, the following notice is placed in the window of A's Anne's Art Gallery. 2 copies of a very rare Blake print, 15,000 each. So what is the scenario saying? The scenario is saying that this is A's Art Gallery and there is a notice at the window and it says 2 prints, 15,000 each. C and D are very keen to acquire the prints but think that the price is too high. They each offer A 12,000 for a copy, but she refuses to sell the prints at that price, although she says she will accept 13,500. She also says that she will keep her offer to them open until 12 o'clock on the following Monday, 13 December, if they each pay her 100 pounds. C and D agreed and each handed over 100 pounds to her. So what is happening? C and D both came up and offer, what did they offer? They offer 12,000. 12,000 each. But, sorry, let me just put it this way. Well, C and D, they both saw the advertisement and they came up to A and put an offer of 12,000. As this, the notice was invitation to treat. It was not an offer. This is the very first offer of this contract, 12,000, which A rejected, and A put a counter offer of 13,500 to C and D. Moreover, A said that if you want me to keep the contract open for you people till Monday, you need to pay me 100 each. You need to pay me 100 each, which C and D did. And A said that inform me before 12 o'clock Monday. On the Saturday before the deadline, C and D have to leave the country on business, but before they do so, each posts a letter stating that they agree to buy one of the prints at the agreed price of 13,000. Both of them sent a letter. C's letter arrived at 9:30 on the Monday morning, but D's letter is delayed and arrived on the morning of Tuesday. So C's letter arrived 9:30 Monday, whereas the time was of 12 o'clock noon. D's letter arrived Tuesday. So what is the examiner asking you? Which two of the following statements concerning offers are correct? An offer is a definite promise to be bound in specific terms. An offer can include uncertain terms. An offer can be made to a specific class of person. An offer should be made verbally in order to be valid. Well, the answer is A and C. A and C are the correct answers. So if you tick A and C, you'll get 2 marks. See, in MTQs, again, you're just going to get MCQs. Which of the following correctly describe the nature of notice in A's window? What is the notice in A's window? Invitation to treat, offer, invitation to tender, or what? It is invitation to treat. Which of the following parties does A have binding contract with? C and D. So A has a contract with whom? So now acceptance is coming through post. So if we apply postal rule over here, postal rule has two conditions. Parties should know that acceptance is coming through post. And in that condition, if it is lost, it is still considered acceptance. So even the first condition is not satisfied. The party does not know that she'll be receiving letters. So postal rule cannot be applied. However, C's letter received within time. So there was a contract with C. D's letter received after the time. So there wasn't a contract. So what are you going to supposed to do? With C, yes, a binding contract. With D, no binding, no binding contract. So this is how an MTQ would look like. So let's have a break of 10 minutes and Okay. Okay, welcome back, students. So we were talking about the MTQs. Let's talk about another MTQ. So again, you will be given options in the MTQs as well, and you won't be required to type in anything. All you have to do is just choose the correct answer. So let's see. R regularly takes Roger regularly takes part in a sport that involves fighting with wooden sticks. He has been successful in many fights, but recently took part in one in which he lost to Jack. The fight took place under the necessary safety regulations and was stopped before Roger was hurt too badly. However, soon after the fight, it was clear that he had received severe head injuries and he now has difficulty talking. Elle said that is one scenario, and then another scenario. Lulu used a public toilet at her local train station. Unfortunately, the lock was defective and she was stuck inside. In a hurry to escape, she attempted to climb out of the window despite a warning notice not to do so and fell to the ground outside, injuring her head. So, two head injuries are in front of you, two different scenarios. Which two of the following must a claimant prove to be owed a duty of care in a negligence claim? The harm was an obvious consequence of the defendant's action. There was a relationship of proximity between the parties. It is fair, just, and reasonable to impose a duty of care. The defendant has sufficient funds to pay the damages. What do you think would be the answer? There was a relationship of proximity between the parties. Yes, that is one answer, and it is fair, just, and reasonable to impose a duty of care. That is 2 and 3 are the answer. Which of the following statements about Roger is correct? Roger cannot claim the damages from the fight organizer because the organizer can claim the defense of voluntary non-fit injuria. The organizer can say that we have told Roger about the risk already. Roger can claim damages from the fight organizer because the defense of voluntary non-fit injuria does not apply to dangerous sports. Roger can claim damages from the fight organizer because it did not expressly consent to the risk of the injury. Roger cannot claim the damages from fight organizers because the injuries suffered were in reasonable contemplation. Well, the answer is A, because they were. Roger cannot claim the damages because the organizer can claim voluntary non-fit injury. All the risks are communicated to the candidates beforehand. So for that sake, Roger, for the head injury number one, cannot um, take the claim the damages. Which of the following statements about Lulu is correct? Lulu has no right to damages in respect of her head injury, because there was no contract in place between herself and the train station. Well, for a dog, contract is not a must. She has no right to claim damages in respect of her head injury because she voluntarily accepted the risk of injury by climbing out of the window. Well, she has right to claim the damages for the full amount of the harm because caused to her in respect of her head injury. She has right to claim damages in respect to her head injury, but the amount she is entitled to will be reduced because she was partly to blame for it. Well, that is the answer. As you can see, that is the answer, correct answer. So this is how the examiner would talk about certain MTQs with you, and he would like you to solve those MTQs. Let's talk about another MTQ. F Limited specializes in providing software to the financial services industry. It has two offices, one in Edinburgh and the other its main office in London. What does F Limited do? Software to the financial service industry. In January 2003, G was employed as a software designer attached to Edinburgh office. However, in May, G was informed that he was to be transferred to the head office in London, which is more than 350 miles from his usual workplace. G refused to accept the transfer on the basis that he had been employed to work in Edinburgh, not in London. Consequently, on 1st June 2004, he wrote to Fine Limited terminating his contract with them. Which two of the following must be proved in order for a claim of constructive dismissal to succeed? For a constructive dismissal to succeed, the employee breaching an essential term. In a constructive dismissal, employer breaches. So A is not the answer. B, the employer repudiating an essential term of the employment. Yes, relocation is an essential term. This is the answer. 3, resignation of the, that is also required. The employee needs to resign first and then go for constructive dismissal. Employer being unwilling to continue employing the employee. Well, the answer is 2 and 3. Okay. Identify whether the following statement concerning Gus are true or false. G has been constructively dismissed. Yes, that is true. G can claim wrongful dismissal. No, that is for summary dismissal. G can claim unfair dismissal. Yes, unfair dismissal can be claimed. And G can claim redundancy. No, redundancy cannot be claimed. So he can change the format of the question. As you can see, he can change the format of the question as well. So I hope you are getting the understanding how the examiner would be asking you MCQs. He would give you a scenario and he would like you to analyze the scenario. So if you have any question, you can post it in the question window. Let's talk about another MCQ. Impact College provides private tuition. The college is managed by Jack, who also has responsibility for personal matters. Fred, Gail, Hannah, and Igor are lecturers currently employed by Impact College. Manager is the Jack, and F, G, H, and I are the lecturers. F has been employed as the staff trade union representative for the past 3 years and has had several confrontations with Jack as to the working conditions of the college employee. G has been offered twice in the past 4 years on maternity leave, and to Jack's stand annoyance is pregnant once again. H was hired a year ago, but has annoyed Jack by frequently bringing health and safety issues to his attention. And I has been employed on a 2-year fixed-term contract, which is about to end and will not be renewed because Impact College no longer requires an employee with his skills. It has transpired that F, G, and H are amongst 10 members of staff selected for dismissal by the college. And they have evidence that Jack has pursued a personal vendetta against them. Well, let's see. Which two of the following are fair reasons for an employee for dismissing an employee? Which two of the following are fair reasons for an employer to dismiss an employee? Capability, redundancy, taking part in official strike, and pregnancy. Well, fair reasons are 1 and 2. 3 and 4 are unfair reasons. Unfair reasons. Okay, let's see. Which of the following parties have a valid claim to have been unfairly dismissed? Well, Fred is unfairly dismissed or fairly dismissed? Well, F is unfairly dismissed. Let's go back to the question and see what Fred said. Well, Fred has been employed as a staff trade union representative for past 3 years, and he had just brought some, and he was in confrontation or fight with Jack on some issues, and he was just doing his duty. If he's dismissed, he's unfairly dismissed. And Gay has been off for twice a year, and if on the basis of maternity, Gail is being dismissed, again, she's also being dismissed unfairly. And H was hired a year ago but has annoyed Jack by frequently bringing health and safety issues to his attention. And I is on a 2-year fixed term contract. Well, H cannot claim unfair dismissal because she was just a year old in the company. So not unfairly dismissed, and I as well is not unfairly. It is a contract which is supposed to end. It's a fair dismissal. So for H and I, it is fair dismissal. For F and G, it is unfair dismissal. Okay. So H, S, T, and C formed a partnership to run a petrol station. The partnership agreement expressly stated that the partnership business was to be limited exclusively to the sale of petrol. In January, S received 10,000 from Partnership Bank drawn on its OD facility. He told the bank that the money was to finance a short-term partnership debt, but in fact, he used the money to pay for a round-the-world cruise. So 10,000 was being personally used by S. In February, T entered into a contract, 15,000 contract on behalf of the partnership with the bank to buy a stock of bicycle, which he hoped to sell from the garage forecourt. So T received 15,000 from the bank and bought the bicycles which he wanted to sell from the garage. In March 2008, C retired from the partnership, but the creditors were not notified of his retirement until May. In April, the partnership bank refused to honor its check for the payment of its monthly petrol account on the basis that there was no funds in the account. OD facility. 10,000 was taken by S and 15,000 were taken by T. And C has retired. And to H's surprise, there was no account. The OD was exhausted. Okay. So which statement concerning the liability of partner for overdraft is correct? Only S is liable to repay the OD because he used to fund for his own personal use. Only S is liable to repay the OD because he lied to the bank. None of the partners are liable to repay the OD because the funds were not used for legitimate purpose. All the partners are liable to repay the overdraft because S had authority to withdraw the funds. Well, all the partners have the authority to repay they have the liability to repay the OD. Answer is D. Unlimited liability for all the partners. Which statement concerning the liability of partners for the bicycles is correct? All of the partners are liable because T has apparent authority to enter into the contract on behalf of the partnership. T has brought the bicycle and all the partners have apparent authority. If T is doing that and other partners are not basically stopping them from doing so, so they have the apparent authority. None of the partners are liable because the contract is outside the scope of partnership agreement. Only T is liable because he authorized the contract which is outside the scope of partnership agreement. All of the partners are liable because the contract is within the scope of partnership agreement. Well, the most suitable answer seems A. All of the partners are liable because T has apparent authority. Why the partners have given him the authority? Which of the partners are liable for the petrol account debt? So for the petrol account debt, who's liable? Is the resigning partner liable? Yes, because the petrol account debt came up in April and everybody was informed in May about the resignation. So technically the person is still a C is still a partner. So H, S, T and C, all four of them are liable. So these are the certain questions which the examiner can ask you as MTQ questions. Okay, so note me. Did you go back on MTQ true and false question? Okay, so which MTQ, Sianu Pasha, you want me to go back to? MTQ true and false question? Can you please specify? Okay, so this is the true and false question. So this is regarding MTQ number 3, and this is the question. So what is the question that you want to ask? You want me to explain it again? Okay. Let's see. So we have to decide that this is MCQ number 4, that who has been fairly dismissed and who has been unfairly dismissed. So it's not an unfair dismissal. So you have to say that, we would see that G has been constructively dismissed, G can claim wrongful dismissal, G can claim for unfair dismissal, or G can claim for redundancy. So at Fan Limited specializing in providing software, and G was basically appointed in one location and he was asked to move to another location 350 miles away, and he did not want to go to that location, so he wrote and asked them to terminate his employment. So who has breached the contract? Well, changing the location without the consent of the employer has breached the contract. Whenever the employer breaches the contract, it is constructive dismissal. Constructive dismissal, so is it constructive dismissal? Yes. G can claim for wrongful dismissal. Well, wrongful dismissal is for summary dismissal. The answer is false. For one, it is true. For two, it is false. Well, for constructive dismissal, you can go for unfair dismissal claim. You can claim that I have been unfairly dismissed. This is unfair on my part. And if you can claim, remember, unfair dismissal and redundancy are mutually exclusive. If you want to claim unfair dismissal, you cannot claim redundancy because redundancy is a fair dismissal. So if the answer is yes for unfair dismissal, it is going to go for no for redundancy claim. I hope that answers the question. So this was a little practice. We'll do some more questions in a tomorrow's session, and we'll also be talking about some other technical issues in tomorrow's section. So if you have any questions, you can ask. Just two areas of the syllabus are left: liquidation and company offences. Okay. So if you have any questions, you can put your questions in the question bar. All the recordings are available. You need to get the consent for the provision of the soft copy of the book. And so this is all about meetings, directors, and all these areas. And 30% for MTQ section, where 5 MTQ 6 mark each, 30%. It's not going to be tough if you have all the technical knowledge regarding the area. So you need to have technical knowledge just to solve these questions. So 70% of the MCQs, 25 2-mark questions with 4 options to choose from, and 20 1-mark questions. So all the handouts are the slides are available in the handout section for the previous 3 days and today's as well. Tomorrow would be the last class for this session, and we'll be talking about issues like liquidation, issues like administration, and the criminal offences governed under the Companies Act, like money laundering, insider dealing. So we'll be talking about all this stuff in detail in our tomorrow's session. So all the questions are being answered, and we're done with the practice. So thank you so much. We'll see you tomorrow, and thank you for joining. So there's no WhatsApp group so far, and you have an email ID where all your queries will be answered. Thank you for joining. Do join in tomorrow as well. Thank you.